David Weiskopf, and I will call to order the Sheriff's Office Retirement Plan Board of Trustees meeting for this February 24th, 2022. Time is a little after 1. Location is the Chesapeake Building in Leonardtown, Maryland, and I guess we will start with a roll call of the members. To my left.
John Walter, Citizen Representative.
Jeanette Cudmore, Chief Financial Officer.
David Weiskopf, County Attorney.
Lieutenant Sean Moses, Plan Member.
Thank you. And first, we will ask for the approval of February 24th meeting agenda.
So moved.
I will second.
I have a first and a second. All in favor, vote aye.
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 Aye. Ayes have it. Motion carries. Next is the approval of the January 27th meeting minutes. We'll entertain a motion.
Can we start that again? What? The January 27 meeting?
January 27th meeting minutes.
So moved.
Second.
I have a first and a second. All in favor, vote aye.
Aye.
Aye. Ayes have it. Motion carries. Next, moving right along, is new business with Mr. Wing.
All right. Thank you, Mr. Weiskopf, and good afternoon, everyone. So you can see we have a number of items on the agenda today, and we'll start with the fourth quarter performance report. So you have a packet in front of you. The Q4 report will be the one on top, the thicker book. And once you have that in front of you and are ready, if you could grab Exhibit 2, so skip over Exhibit 1, grab Exhibit 2, flip that over, and then you'll see the cover page there listed as Market Environment. And we'll begin where we always do on page 9, as you know, just spending 5-6 minutes on the economic environment, the capital markets environment, to provide context for how and why the fund performed the way it did and how and why some of the underlying investment managers performed the way they did. So starting on page 9 in the U.S. economy, we'll start where we always do at the top right, just a high-level overview of U.S. real GDP or economic growth. So in that top right chart there, the bars are the quarterly economic growth numbers. The 3 striped bars you see to the right are estimates as we begin here in 2022, and then the orange line is the year-over-year number. But if I could draw your attention to the last fully colored in bar, the fourth one from the right, that was the Q4 economic data that was released about 3 or 4 weeks ago, and there was actually a revision released early this morning. But economic growth, as you can see, re-accelerated quite drastically from the Q3 economic growth number, and actually came in well above economists' expectations. The revision this morning was at 7%, and the initial expectation from economists was at 5.8%. And like we talk about in the first bullet point to the left, there was really 2 drivers for that acceleration. Number one, decent consumer spending, but the bulk of the driver of economic growth was really private industries, their inventory accumulation. In other words, reinvesting, restocking their respective inventories subsequent to the issues they had around the pandemic, or all the supply shortages across a lot of industries within the economy. And as we look ahead here, again, focusing on that top right chart, but now looking at those 3 striped bars, growth is expected to moderate here in Q1 and then remain fairly steady as we head through 2022. But a lot of that growth is still expected to be driven by private businesses accumulating their inventories. There's still a big runway for them to do that. And as a quick example, we'll just show the retail industry on that bottom right chart on page 9. and specifically their inventory to sales ratio. So you can see over time, if you look at that dotted gray line, that's about 1.5. So in other words, retailers typically carry about 50% more in inventories relative to their sales. But if you look at all the way to the right in the blue line, that fell off a cliff amid the pandemic, and we've discussed in the past the reasons why as far as the supply chain issues and various shortages. And it's important to note that as we shift gears to page 10 and talk a little bit about inflation, that the inflation that we've seen to this point has been really on the goods side of the equation, or the goods sector in the economy. In other words, think about the stuff we buy, right? And it's pretty evident there in retailers as far as their inventories collapsing. When there's less supply of the stuff that we want to buy available, then prices go up. And that's exactly what we've seen to this point. The most recent inflation print through January is about 7.5% from the preceding year, which was the highest level since the early 80s. But as we shift gears to page 10, one of the dynamics that we're seeing now is these inflationary concerns are broadening out in other sectors of the economy, most notably the labor market. And one of the interesting dynamics you can see up in the top right chart here on page 10, where we're showing two series. In green there is the unemployment rate, and please note it's on an inverted scale. So in other words, when that line, the green line, is going up, it means the unemployment rate is dropping and vice versa. Whereas the darker line is what's called the private industry quits rate. So put simply, the percentage of private sector workforce that are quitting their jobs each month, in the hopes of maybe better opportunities, higher wages, or what we've seen recently, a lot of consumers or pieces of the labor market leaving it all together, or just retiring. And you can see how those relationships, or those two series, track each other fairly closely over time. But more recently, you see that darker line consistent with an unemployment rate of almost 1%. So people will leave their jobs when the labor markets are really strong, right? They're confident that they can get a different job or a new job or a better job in short order. And that dynamic now, we think, is really reinforcing how tight and how strong the labor market is, and believe that the Federal Reserve, the policymakers charged with monetary policy, has underestimated this dynamic. So when you think about, and circling back to the inflation comment, when that labor market's strong, and we've seen this more recently, it results in higher wages, right, which is a good thing. More money in people's pockets, drive consumer spending, drive economic growth, but that's just in a vacuum. It's going to have other effects across the economy. And as it relates to inflation, if corporations try to pass along those increased costs through those higher wages, it can result in more inflation across the broader set of the economy. So again, this dynamic, we believe, and we're not alone in this, that the Federal Reserve has certainly underestimated the tightness in the labor market and the potential for the inflation that we've seen on the good side of the equation to become more persistent in other parts of the economy. So with that context, what we've seen, and we have some data on the chart below, but admittedly it's a little irrelevant right now. Towards the end of the year, the market was expecting the Fed to raise rates about 3 or 4 times this year. As we were sitting here this morning, that number's closer to 6 or 7 times, since inflation has been much more persistent than they had previously anticipated. And a lot of the equity market weakness and volatility that we saw in the first 6 weeks of the year, we'd argue, was around these dynamics. Persistent inflation, and relatedly, what is the Fed going to do about it? What are the pace of the rate hikes? What are the magnitude of the rate hikes? So that's caused some investor uncertainty around the economic impact of that, how that might eat into corporate profits, and what that might do to equity valuations. So a lot of those concerns were driving the equity market weakness we saw, say, in the first 6 weeks. So I'm sure, as you all well know, more recent events coming this week, and certainly over last night, has driven even more equity volatility and equity weakness. And we'll give you a more up-to-date look at where the fund stands when we get into the recommendations here shortly. But with that said, good segue into page 12 here, and we'll talk a little bit about asset class performance at a high level, and then I want to break things down from the U.S. equity market on the next page. So we'll focus on the chart to the right here, again on page 12. And specifically, we'll start out with the first three lines or first three rows, the equity markets. And by and large, from a relative perspective, performance was consistent with what we saw in Q3. So those green bars are the Q4 numbers, and you can see U.S. equities leading the way, international equities a little bit behind but posting gains, and then emerging market equities there bringing up the rear. So that was consistent with Q3, but what was different is in many of these areas we saw positive gains. So U.S. equities and international equities were actually in the red in Q3, but posted decent gains in Q4. And even emerging market equities, even though they were still slightly below the flat line, that was a big improvement from Q3 that saw them down more than 8%. Now, why this is relevant for the fund, from an asset allocation perspective, we had an overweight to U.S. equities and an underweight to emerging market equities, so having more money in an area that's doing well and less in the area that's doing poorly has benefited the fund from a relative perspective or relative to the benchmark. If you look below emerging market equities, you see U.S. bonds were essentially flat for the quarter, so that's a proxy for investment-grade bonds, think treasuries, high-quality mortgage-backed securities, high-quality investment-grade corporate bonds. But below that, a riskier area of the bond market, high-yield bonds, so bonds that carry a little bit more credit risk, are issued by companies maybe a little bit more smaller, more leverage on their balance sheets, did outperform investment-grade bonds, which is typical what you would expect when equities are doing well, because investors are, clearly taking more risk, not only within equities, but within the fixed income market. And again, taking this into consideration, so what? Why is this important for the fund? Well, most of the active managers within the fixed income portfolio will hold slices in the high yield area, like Loomis, as we talked about last month, who has a decent chunk within sub-investment grade debt and even some in equities. So that was a tailwind for their strategy relative to the benchmark. The last thing I'll mention on this page, if you look at the bottom three rows, starting with TIPS and then commodities and REITs, these are more inflation-sensitive assets, and with inflation still being relatively high and quite persistent, you can see TIPS up about 2.5%, so they outperformed the broader investment-grade market, which was flat. Now, commodities was the lone outlier there. A lot of that market is driven by what happens with oil prices, and before the recent rebound this year, in Q4, oil prices came under pressure given concerns around the Omicron variant and what that would do to demand. But since the end of Q4, they have risen quite dramatically. And then finally, REITs at the bottom of the page, they're more of an inflation-sensitive part of the broader equity market. You can see up about 16% compared to broad U.S. equities at the top of the page of around 9%. So with that said, I just want to spend a quick minute here on page 13 and take a look under the hood in the U.S. equity market. And I'll really be referencing the second and third bullet points because they're most relevant for the fund. So in the second bullet point, you can see similar to Q3, what did best from a size and a style perspective. Style meaning value and growth stocks were large cap growth stocks, so the Apples, the Microsofts, the Facebooks, the Googles, so on and so forth. So that was a little bit of a headwind for the active large cap growth manager within the fund. They tend to have more allocated to mid cap stocks rather than large cap stocks, with the latter having done much better than mid caps. But another big driver, as we talk about in this third bullet point, even though large cap growth was the best performing area and outperformed large cap value stocks, once you get into more mid-sized companies and smaller companies, the opposite was actually true. It was actually value stocks that outperformed, higher quality stocks that outperformed. So that was actually a tailwind for the active small cap managers because they tend to have an underweight to more lower quality stocks, which underperform quite drastically. However, that same dynamic was also a headwind for the large cap growth manager. As I mentioned, they tend to have more mid cap stocks. And a lot of those allocations are concentrated in some of the names that I would call the supposed pandemic winners, if you will. The Zooms, the Pelotons, the DocuSigns, the stocks that were supposedly going to have these secular tailwinds from the working from home, staying at home, e-commerce sort of environment. And they really took it on the chin during the quarter at the prospect of the economic reopening as we head into the new year. And again, at the prospect of rising interest rates also really caused them to underperform. So those two key dynamics of mid-cap growth underperformance and then more pandemic sort of stocks within the small and mid-cap space were huge headwinds for the large cap growth managers I'll show here shortly. But with all that said, let me pause here. Any questions or comments before we get into the results for the fund itself? Okay. So if you would all please grab Exhibit 3 now, flip that over, and we'll get into the details of the results here. So starting up top on page 19, you can see the observations for the fund. So we'll give a little qualitative background and then get into the data. So the market value of the fund at the end of December was a shade under $140 million. There was an investment gain of $4.7 million, but then a portfolio return of 3.5% net, which was a little bit behind that policy benchmark of 3.9, and I'll explain the differences here in just a second. But at the same time, as we always note, those private market investment values are still as of 9/30, so given they comprise about 13 to 14% of the fund, the Q4 return is likely understated. Since public markets have done quite well, we would expect that the private market values, once we get them, would also see some upward revisions. But again, since it's such a large component of the fund, that 3.5% Q4 return will likely be revised upward once we get those values. Now, as far as the next two bullets, these are really meant to explain the difference between how the fund did in the policy index. And if you look at positive attribution, that was what's helpful. And you can see it's a long list. So asset allocation was helpful. Within equities, having more money in U.S., less in emerging markets. Having no money in commodities was helpful. Having less in hedge funds than the policy was helpful. And then you can see some other dynamics here listed below, some outperformance by some of the managers. So you say, well, a lot was helpful, and then we only have one item under the negative side, and as I'll show in just a couple of minutes. This is the large cap growth manager, and then they were quite a bit behind their benchmark, so far much that they offset all of this positive attribution and then some. So we're going to spend a couple of minutes talking about that later. The looking ahead, at the bottom of the page, we'll tackle that in the next set of the materials. But if we can move on to page 20, more of an executive summary page, and start with that top table, the summary of cash flows, specifically the first column there, the fourth quarter, you see we began at $134.2 million. The fund has positive cash flows there. You can see during the quarter of about $550,000. So when we take that into account, plus the investment gain, the fund itself grew by about $5.25 million during the quarter. The returns in the middle of the page here we'll hit more shortly when we look at them from a peer perspective, and we'll also hit the asset allocation at the bottom of the page when we look at the recommendations. Remember, these data are as of the end of the year, so prior to the new policy statement coming into effect. So when we look at the recommendations, we'll look at the current allocations in relation to the current policy targets per the board-approved IPS at the beginning of the year. So if we can move on just quickly on page 22 here, give you an update or more of a quick review of what took place during the quarter. So again, this is showing, like we talked about on that previous page, the beginning market value, and as you work your way from left to right, net cash flow, net investment gain, and then that's how you end up where your ending market value, but broken down across all the various investments within the fund. So if you focus on that net cash flow column, you can see about 8 rows down, one of the key changes made during the quarter was a redemption of $1.25 million from the PGIM Jennison International Opportunities Fund. That's an international large cap growth manager that had been performing quite well. Those funds were moved directly into the Fidelity Emerging Markets Fund, even though the fund has lagged, as I showed, is more a reallocation within the equity market, essentially selling something that has done well and buying something that's much more cheap or much more attractive given recent underperformance. Another item I want to note below that, you can see negative $39,000 under the positive 125. So this is the Blackstone Real Estate Income Fund. So just as a quick reminder, as I'm sure you all well remember, there were 4 or 5 private real estate funds earlier last year. We were able to exit most of those positions. This was one of them that was already undergoing a process of self-liquidation. And as you can see there in that column, the negative cash flow there, plus that investment change, it's fully liquidated now. So all that money has been returned back to the fund in the form of cash. Below that, you see a couple other redemptions of about $500,000 from the global listed infrastructure manager and then $2.25 million from REITs. And as you'll see here shortly, that was mainly for cash purposes and rebalancing back into fixed income. And the former, as we've talked about in the past, due to upcoming drop payment needs in the first quarter, we talked about raising that money when things were going well, right, when markets were ramping up, and we had more certainty of we need the cash, now's an opportune time, let's not worry about the uncertainty of what might happen over the next 3 or 4 months. That was really for raising cash and fixed income. As you look down the rest of this page here, these are mostly the private market investments, and even though we don't have the 12/31 values, we update the values for the capital calls and distributions because they're coming out of the cash accounts for the fund. So on page 23 here, a couple items I wanted to bring to your attention. The first one being in the first row there, where you see all the way to the left, the Blackstone/GSO Secure Lending Fund. So we talked about this in the past. This was a private debt investment, but underwent a recent IPO. In other words, it was spun off and now is a tradable security. So essentially what has happened is the private debt investment, the one up top, is liquidated. And now you can see that position is about 3 rows up from that blue row there, where you see, again, the Blackstone GSO Secure Lending Fund, but that's representative of the tradable security now. So you can see the net cash flow there's a little higher than what came out of the private debt fund because there was a nominal contribution that was needed to be made before it spun out of about $6,000. So that's why those numbers are slightly different. But if you look to the right there, and this will be more evident when we look at the performance, even though it was just about a $1.5 million contribution, there was a pretty big investment change to the upside, namely that the IPO happened, then the security traded essentially 16 to 17% higher than the IPO price as we closed out the quarter. So there was a decent investment gain there. As you work your way back up more to the middle of that net cash flow column, just to illustrate some of the rebalancing I talked about earlier, you could see positive $1.25 million going into one of the fixed income funds and another $500,000 going into the another fixed income fund. Again, that was most of the liquidation of the infrastructure and real estate manager. And then all the way below that second line up from the blue, the cash account, right? So the residual amount that was raised, the 1.1 million, was in anticipation of drop payment requirements that were going to be needed on 1/1 and then again on 4/1, which we'll talk more about shortly. So again, let me pause here before we jump into the returns to see if there are any questions or comments around any of the information so far. Okay. So you can skip page 24, 25, 26. It's just breaking down asset allocation and manager allocations on a little bit more of a granular basis. And if you go to page 27, I'm going to make some comments here and then use page 28 for some further context around the private market investment impact for once we get those data. But again, as you know, we use a third-party platform to generate these reports. Gives us an opportunity to compare and contrast how the fund is doing relative to other public defined benefit funds out there. And the key takeaways are really the circle and the triangle. In other words, the bottom 2 rows that you see on that page. So as you work away from left to right there, you can see that 3.5% and then 3.9, as I mentioned earlier, and then the rankings in parentheses. So the 3.5 was in the 81st percentile. So higher numbers are below the median and vice versa. Now, with that said, if you could look at page 28, please, and that same column, this data is as of September 30th. So those same 2 bottom rows, and then that first column. So initially, when we reported the Q3 return, it was down 0.4%. After we had received the private market values, it was revised up to 0.4%. And the ranking moved from the 72nd percentile to top 14%. So again, given those private markets comprise such a large portion of the fund, it's important to restate that, not just restate the data, but give the board some context about, the material impact that it can have. So if we keep that in the back of our mind, and again, circle back to page 27, that 3.5%, we think it's reasonable given how strong public markets were, that will sort of end up maybe in that 4.5% range, which will get us closer to the median. And then if you look at the fiscal year, again, if we get a similar revision, we should be comfortably above the median. And then for the 1 year, it's been a decent start, I think, to the relationship here. 1 year being 2021, a little bit ahead of that benchmark and in that top quartile. And again, if we get a decent revision, we should be firmly above that. So the long and short of it, before we get into some of the manager data itself, is, if you recall last year, we met in January and we came in here and had admittedly a lot of recommendations for the board to consider because we thought the board had a lot to consider given the state of the fund. And when I say the state of the fund, I mean the exposures. If you recall, we had a lot of tilt or overweights to small cap stocks, growth stocks, things of that nature. So a lot of the recommendations we made were to take a more balanced type of approach. So long story short is, over time, if we can get more right than we can get wrong, because we are not going to get everything right, then ultimately we should be in a better place. So it might not happen quarter in, quarter out, or even year in and year out, but if it can happen consistently over the very long term, we should end up in a good spot. So with that said, if everybody wants to jump to page 31 here, I want to dig deeper into some of the managers themselves, and specifically one of them that I spoke to at length already. So anytime you see a darker row here, this is going to be either, in the case of the first row, the total fund, or the other darker rows, essentially an asset class. So we talked about the returns up top for the quarter already. So I want to break things down now by asset class, starting with the total equity composite or total equity asset class, the second darker row. So that's a weighted average, the U.S., developed non-U.S., and emerging market managers. So you can see that was up 4.2% versus 5.5 for the policy index. So the underperformance at the total fund, all driven within equities. And if you look at the third darker row there, U.S. equities drove the underperformance within total equities. So why was that? So there are 5 managers within U.S. equities. The first 2 are index funds. You can see the total stock market index and the value index tracking their indices on a net of fees basis, as we would expect. But again, the key detractor there in the middle, where you see American Century Focused Dynamic Growth, was down 2.3% versus the benchmark, which was up 11.6%. So again, a huge underperformance from one manager really driving the underperformance of the fund. So I'm going to take a step back here in just a second and talk about the implications. But, admittedly, we did not make a recommendation to change that fund out. We tackled other issues, and admittedly, we underestimated how far that fund could deviate from the benchmark. So that was a mistake on our part, and admittedly one that's been eating at us since we saw the numbers. So before I get into a specific recommendation around this, I want to provide some context. So as you know, if you look all the way to the right under American Century, you can see August 2020, right? So this was a legacy manager before we began working with you. So I did a little digging in. So, it'd be helpful to say, who was the manager before this? I didn't know. And it was Loomis Sayles. It was a large cap growth manager. So why is that important? I just want to do a broad illustration of the key considerations when you're considering changing managers. So I thought it'd be helpful. Well, how did Loomis do last year? Right? Because typically when institutions make changes, you typically, more often than not, because of behavioral risks, right? We're all humans. We sell low and buy high. So we sell a manager after they've underperformed, and then we buy one after they've outperformed. So Loomis was behind last year, but they were still up close to 20% compared to just over 7% for American Century. So I provide that example just to, again, illustrate the importance of not acting rashly, right? Not making the wrong decision at the wrong time. Now, that's not to say American Century, we might not recommend a change in the future, but to take a more prudent, say, more measured approach, we need to recognize that active manager performance can move in and out of favor over time. So in other words, if we came in here and said, we need to make a change today, we're locking that underperformance in, right? And I think it's something, again, based on history of how these decisions are made, it would be prudent to continue to monitor them, but more formally for the board to consider putting them on the watch list for performance reasons. I think that would be a measured and very reasonable approach. So let me pause for a second here to see if there are any questions, and also to ask, I don't know if that is a formal vote that needs to be made or not, or something for us to just say, we recommend that they're on the watch list, because per the IPS, it is the board has the authority to do that, obviously, based on our recommendation. So let me pause there.
I've forgotten the specifics, but don't they have to be in the danger zone for multiple consecutive quarters?
Before considering a change? Yes, sir.
So do we have that here?
I'm sorry, you mean in the danger zone based on relative performance or based on how long they've been on the watch list?
Now, to put them on the watch list, they would have to underperform by so many quarters or, oh, I'm sorry. Our previous policy statement said that they had to be underperformed for so many consecutive quarters, or I believe there was even a statement in there about a significant decrease in one particular quarter. So I don't know, I can't recall what we put in, what the final determination was for our policy statement that we just revised.
It's not explicit in the sense that there's no, trigger points around it. So I think more broadly speaking, and even if it is, you can see the 1 year period, which is 4 quarters, obviously quite a bit behind, and then all the way since inception, which is more than 5 quarters, quite a bit behind then. So even if we did have that trigger, I'm sure they would have met it, just based on what's happened more recently. I think as far as placing them on the watch list, again, doesn't necessarily require any future action. They don't get new monies while they're on it. But again, if we don't see some improvement, then we could possibly take some action. But in a perfect world, they would outperform over the next few quarters and then give us an opportunity to revisit. In other words, recouping some of that underperformance that we've seen more recently.
I'm trying to dredge something up. I thought, and maybe we've changed this, but if somebody went on the watch list, they were not getting new money, correct?
That's correct.
We would put them, they would be there for maybe a couple of quarters until we decided, well, let's make a decision and move it to something else.
I
Yeah,
believe that's
so-
what Pat's suggesting.
Right,
Well, so they had a chance to work their way off the bad list.
right.
Okay. But to getting on it, was it X number of quarters out of 4, 3 out of 4, 2 out of 4?
I don't have that.
It's
I'm pulling it up right now.
The old one, that's accurate.
that I don't believe there were stated timeline guardrails. I think it was a list of potential concerns, whether it be performance, personnel changes, team changes, outflows, organization issues, but it wasn't explicit and say if these guys underperform for 4 consecutive quarters, they're automatically on the watch list. I think it gave the board more, or at least some latitude around when to put
Even
some.
that one minus 1.9, which is 4 quarters, but that's how they,
That's fiscal year, sir.
July.
Yeah, so the 1 year, but to your point, Mr. Walters, the 1 year, which has been 4, and then since inception, which has been a little more than 5,
all right, 7.4.
right, yes, sir.
I pulled up the policy statement. It says the board may place investment managers on a watch list for the following factors. As Pat said, failure to meet performance standards, departure of one or more key personnel, significant change in ownership or control of the firm, significant loss of assets under management by the firm, significant change or drift in the management style, substantive change in portfolio turnover, any violation of SEC rules or regulations, or material litigation against the firm.
Okay, so we really took the concrete guardrails off of the thing.
Right.
Yeah, okay, I'm back on track now.
Okay. So to Ms. Pratton's comments there, that obviously the authority to place a manager on the watch list falls with the board, so we are recommending that, but again, I don't know if it requires a formal vote or not.
I'd be more comfortable if it did.
I think so, but let me understand. The American Century, is that an index fund for the Russell 1000? or it's not, correct?
No, it's an active manager and the
It's
Russell
an active
1000
manager, and we...
That's their
right,
bogey.
Right, well,
Right.
I mean, this just gets back to my personal belief that active managers are, I'm just an index fund person. You can laugh at me or not, but, you know,
For the 40% beat the index, but that's okay, that's different.
see, I always thought you were more conservative than me, but, well, do I hear a motion to place American Century on the watch list?
So moved.
I'll second.
I have a first and a second. All in favor, say aye.
Aye.
Aye. Ayes have it, motion carries.
Now, do we at this point want to memorialize checking back, like 1 quarter, 2 quarters? How long are we going to let it run?
Well, when's our next meeting?
So we'll run through the next quarterly performance report in June. I don't believe we meet in May.
Right.
So then we'll have another quarter to look at.
Right,
All right, I'm good with the quarter.
yeah.
Right. So we can revisit it at that time as well. Again, and manager performance is cyclical, right? You know, they can be in favor or out of favor for as long as 2 or 3 years. But so as we look ahead here, you know, it's possible that they could continue to underperform, but in a perfect world, they would recoup some of that. And even if they're taken off the watch list, then the question is, does the board want to tolerate this sort of deviation from the benchmark? And if the answer is no, then we need to consider a change despite the fact that they've recently outperformed, right? So again,
And we need to remember that the events of yesterday, they're a headwind for everybody for right now and for maybe, I don't want to penalize them unfairly because everybody is going to be struggling here for a while.
on an absolute basis, without a doubt, but on a relative basis.
Right.
Yeah. So, okay. So just quickly, under American Century, on a more positive note, you can see the 2 small cap managers there, Virtus KAR, Kane Anderson, and then William Blair below them, both ahead of their benchmarks and ahead of their respective peer groups. Again, they're more high-quality focused, certainly in the name of Kane Anderson, and then William Blair, more of a value shop, which outperformed more growth-oriented stocks. So they were both, again, ahead of their benchmarks and ahead of the peer groups. As far as developed non-U.S. equity, you can see at the aggregate level, the 3 managers in line with the benchmark. The first there, Schroders, the international value manager, outperformed during the quarter, mainly due to an underweight to emerging markets and financials underweight as well, which had some headwinds with a flattening yield curve. And then on the bottom, PGIM, Jennison International Opportunities Fund, they offset Schroders' outperformance, mainly due to stock selection during the quarter. So on page 32, you see the emerging markets composite. That's going to be more or less in line with the benchmark over time, given it's one passive fund. There can be slight deviations from time to time just based on the nature of how the index is valued. It's actually valued when those local markets closed. But the index fund itself, given it's traded in the U.S., sometimes has to make price adjustments based on performance within the U.S. equity market between when those local markets close and when the U.S. equity market closes. But you can see in line with the benchmark during the quarter. Under real estate, 2 managers there under open-end real estate, really a moniker for the more liquid part of the real estate bucket. Cohen and Steers, they're the infrastructure fund, a little bit ahead of the game and the universe for the quarter. Fidelity, the real estate index fund, essentially matching its benchmark, which we would expect. But behind the peer group for the 3-month and the fiscal year, and really the dynamics around that, whereas Fidelity's generally more diversified. It's an index fund. They hold more small and mid-cap type stocks than most active managers. And just like the broader equity market, larger companies have done well within the REIT area. So that was a headwind from them, at least from a peer perspective. We'll talk more about the closed-end real estate shortly, but as far as the hedge funds are concerned, just quickly, there's 3 names there. As you know, Hatteras is a fund that's being wound down over time. I don't have the total context for the history of that, but it's something that was approved to be terminated years ago, but unfortunately, we only get back about $7,000 per quarter. There's only about $24,000 left in there, so I'm hopeful that that's fully liquidated sometime in 2023. The main part of this bucket is in the middle, Millennium, so that was the manager we recommended the board keep. You can see they were about 2 percentage points ahead of their benchmark for the quarter, so a strong quarter from Millennium. And then finally, Morgan Stanley, that fund of hedge funds, if you will, similar dynamic to Hatteras in that it's being liquidated, but we don't get to submit tender documents. Essentially, they return the money over time. So they returned a little bit in Q4. They only have $4,000 left, so we're hopeful, much like Hatteras, that fund is really off the books over the next 12 or 18 months, but unfortunately, we have no control over it.
Do they ever accelerate the payout when they get down to small numbers?
We haven't seen that. We've actually, what I said, Hatteras, it's quarterly liquidity. I mean, you would hope so, but for Morgan Stanley, I saw one payout this year, maybe two. So it's just something I think that the positions that they still hold are probably more illiquid, and they're trying to liquidate it and at least protect, the remaining shareholders from bearing those costs. So again, hopeful that within the next 12 to 15 months, that's essentially off the books. As far as private equity, we'll tackle that again in just a minute. So if you flip to page 33 before we get into the private market investments, if I could just draw your attention to fixed income, so the third darker row there, you see up 2.2%, well ahead of the benchmark. So as I mentioned, a couple of the active managers outperformed. But if you look all the way to the bottom there, in that last lighter gray row, again, the Blackstone GSO Secured Lending Fund, there's no quarterly return because the IPO took place at the end of October, so it wasn't around for the full 3 months. But if you look all the way to the right, in the 2 months that it was around, again, the IPO had a price of $26.15, and it ended up trading closer to $30 or $31 towards the end of the quarter. So since it's about 10% of the fixed income allocation and was up almost 20%, that really drove the fixed income bucket. So as I mentioned last month, the way those shares are being delivered, it's over time. Normally with any IPO, there's, a lockup, if you will, for existing investors. So we're reflecting the full amount of the fund's interest, but we only have access to 10% of the shares at this time. We'll get another 15% on March 1st, 25 May 1st, and then the remaining 50% on July 1st. So just wanted to point that out. Because it's almost $2 million, we can't really do anything with it until we receive more shares or the bulk of the shares, which should happen over the next 4+ months. And as we do get those shares, we'll come back to the board with recommendations on how to proceed with that investment. Now, to wrap up quickly on page 34, just a couple brief minutes here on the private market investments. You can see closed-end real estate and the 3 managers within that bucket. Again, there's a lot of information on this page here, and the key metric is all the way to the right there under the performance header where you see IRR. So we talked about this previously. When we looked at the returns on the previous page, those are time-weighted returns. So they reduce or completely remove the impact of cash flows because the managers on those previous pages don't control the cash flows. The board does, when to take it away and when to add it. These managers, as you know, they control the cash flows, right? You make a commitment, they ask for it, the timing, the magnitude of the cash flows, and then the timing of the magnitude of when they give it back. So that IRR is what's called a dollar-weighted return. So in other words, when they're managing more money, the periods where they manage more money have greater weight in the return calculation than when they have less money. Now you can see in the blue box there, the IRR around 18%. That was quite the notable uptick from June, and this data is as of September, which was around 14%. So again, if your money's locked up in an asset class, you want to be compensated with a premium to public markets. So if we would think, regular REITs will return 10-ish% over the very, very long term, we would want this bucket to be in that 13 to 15% range. So at least at this point, it's a little above those expectations. It's a similar story for the private equity composite. Again, if you look all the way to the right in that table, all the way down below, you can see the IRR shade under 18%. It was about 17.4 last quarter. Much like real estate, you're going to do this. You want to be compensated for the illiquidity. So we would want that number again to be in that 13 to 15% range. So we're a little bit above that, at least through September. And then finally, wrapping up on page 35 here with the rest of the private market investments, you can see the four managers within those. Again, the IRR all the way to the right there in blue at 9.27. That was a slight uptick from 9. Now we're not going to get the same bang for our buck in private real estate and private equity because those are equity investments where this is debt. So you want a premium to then the public debt markets. So in this neighborhood, we'd be looking for this to be in the 9 to 11% type of range, and we're just within that band. So I would argue performing in line with expectations to this point. So that wraps up my comments for the performance report itself, but please let me pause here to see if there are any questions or comments from the board around the information.
We still show what, like $3.5 million in cash and Wells Fargo and what is it, the money market or?
Yes, and we, Mr. Weisskopf, we have that data in the next set of material, so we'll give you the specific dollar amounts across all the asset classes as of last week.
Okay, and we're somewhat close to moving that somewhere else?
So we are close. We have an upcoming drop payment on 4/1, and then it's actually a little lower than what we had previously been expecting. It was 1.6, and now it's 1.1. So taking the lower cash need into consideration, we also have a recommendation given that, which I will admittedly modify because this data is a week old and markets have been volatile, to say the least, over the past week. But we'll look at that cash in just a minute.
Right, I understand. I guess I'm referring to the Wells Fargo in general, that we are moving away from them. Is that correct?
No, sir. So we'll have an update on the custody RFP here in a second, but that whole
That's
process.
different than this Wells Fargo money market?
So the Wells Fargo money market is just the cash
Right,
within
that's
the
what I thought.
fund. Right, but the custody RFP process is from the custodian or the bank's perspective. So
Okay,
who's holding the assets?
Okay.
The money market account is just the cash account within.
So that's going to stay Wells Fargo?
If you move.
That's what we're looking at moving, correct? That's what I think.
If we go
Depending
to
on
one of the two this
Custody
morning,
selection.
Oh, no, then there would probably be new options for bank, if you change custodians. But as far as the recommendation, yes, sir, it would be around the.
I'm just unhappy being on a board that has anything to do with Wells Fargo, given their unethical conduct over the last couple of years. So I just want to hurry up and get out of it. I'm just,
So Wells sold their investment
Right.
business to the principal.
Right.
So as of last weekend, we're with the principal.
okay.
And then the custody RFP will take
Okay.
place, and we'll see where.
Because if I'd have been on this board a couple of years ago, I'd have been arguing for us to get out of there. They're an unethical business. And I think I've paid hundreds of millions of dollars in fines, but that's just me.
no, it's not just,
Okay. So I'm glad we're moving in that direction then.
Okay. So is the board comfortable moving on and our
I think we
next?
need a motion.
Oh, I apologize. Go ahead.
I'll make a motion to accept the fourth quarter report.
I will second.
We have a first and a second. All in favor?
Aye.
Aye. Ayes have it. Motion carries. Now on to the recommendations, right?
Yes, sir. So this is in your second packet, a little bit smaller, but if you can grab Exhibit 1 there, flip that over. So you see the cover page there, recommendations, and then again, I am going to walk through this in a little bit more detail given recent events. So we'll start here on page 4. So first thing to take a look at in the top row in blue, see total assets of the fund a shade over $133 million. So at the end of Q4, we were 139.5, I believe. This is as of about a week ago, as of February 16th. I reran the data this morning, and now we're around 129 million based on the events of the past week. Like we talked about earlier, the equity volatility around the Russia-Ukrainian situation, to put it mildly. So with that said, before we get into a specific recommendation, if I can draw your attention to the right, the smaller box to the right where we're showing asset allocation, and then that difference column. So again, this is a week ago, so you can see the negative 0.4 basis points where we're almost in line with the equity target as of about a week ago. As of the end of business yesterday, we're 1.3 percentage points below the equity target, since equities have had material weakness and declined notably over the past week. The other key change here, private markets hedge funds have been relatively constant. Real assets have moved up from 1.3 to 1.5 overweight. Fixed income has come down, as you would expect, really there to be the ballast of the portfolio of almost 4 percentage points underweight to now 3.5. And then cash at 1.2 has moved up to 1.3. Obviously, that has stayed constant, whereas a lot of the other portfolios has declined. So with that said, if you look in all the way down the page, in the rebalancing column in the middle of the page, you'll see negative $500,000 coming out of Wells Fargo money market account. So the reason behind that number, as I mentioned earlier, the drop payment was estimated on 4/1 to be $1.6 million. It's now going to be in the neighborhood of $1.1 million. So once that $1.1 million, at least on April 1st, comes out, cash will essentially be in line with its 2% target, given we raised that money in Q4 last year.
Is that adjusted because we had a number of participants who opted to not reach their drop date? Okay.
Yes.
So originally, as you could see, we had made the recommendation for those funds to be moved in the Fidelity U.S. Bond Index Fund. What I would like to modify that recommendation, given equity markets are down before today around 12% or so, and along with today might be closer to 14 to 15%, to instead of moving that within the Fidelity U.S. Bond Index Fund, that the $500,000 is instead moved into the first investment all the way up to the top of the table, namely the Vanguard Total Stock Market Index. Now, we don't know what's going to happen. I'll be the first one to tell you that tomorrow, next week, next quarter, this year. But what we do know is that markets are undergoing their biggest correction since the pandemic. And since the fund has since the fund has positive cash flows, that makes us more comfortable knowing that we're not going to have to sell equities to meet cash needs, and therefore, just by the nature of the market movements more recently, we're now have an opportunity to rebalance back into equities after they've declined by about 15% or so. So again, if you look on page 5 and just modifying it, the recommendation for the board is to approve the proposed rebalancing, but now instead of moving $500,000 to the Fidelity U.S. Bond Index Fund, to change that to the Vanguard Total Stock Market Index Fund. However, it would still come from the cash account as previously proposed. So with that said, again, let me pause here for any questions or comments.
I'm not getting something, because when we were discussing book number 1 on page 20, I was surprised when it said the policy for hedge funds was 12%, because that seemed high to me, but here the policy is 4%. So what am I not getting?
So on as of 12/31, it was still the old policy.
Oh, that's right.
And now 1/1, it's the new policy. So
And we went from 12 to...
Yeah, I
right.
apologize.
No.
I said I was going to walk through that, and then I didn't. But those targets that you see there, sir, those are the new policies.
Right. That makes sense. Okay.
Okay. Yes.
I'm not against doing this recommendation, this change, but I think we need to be prepared then if there is a spring back of stocks, which sooner or later there will be, then we're probably going to have to rebalance again, right?
Well, it depends, right? So if we think about it just numerically here, $500,000 is about 0.4 percentage points of the overall fund. So if we're down 1.3 now, we'll be below 1 percentage point underweight. And if stocks do rebound, then the next time we meet, and we don't know this to be the case, then we might be in line with the proposed target. So it really, it's hard to say, sir, when, we meet in 4 weeks just based on the uncertainty and the volatility, or we could meet in 4 weeks and say, now we can buy even more cheaply. We hope that's not the case, but, we need that sort of discipline, I would argue, to do so if that opportunity presents itself.
Well, I'm in favor of not doing the U.S. bond index and am in favor of doing the Vanguard Value Index with the proposed 500,000 from cash.
So you would want to do the value instead of the total stock?
Oh, I'm sorry.
Oh, okay.
One line up.
So is that a motion to place $500,000 in the Vanguard Total Stock Market Index Fund?
Yes.
And I'll second.
I have a first and a second. All in favor?
Aye.
Aye. Ayes have it. Motion carries. Thank you.
Okay. Can we move on to the next section, or do we need another vote?
No, that
Or
we're
motion.
fine.
Oh,
We can
okay, I'm
totally
s-
move on, thank you.
One of these meetings, I'll get that. I know. I just know it. So our next section, and this is really going to be the bulk of our remaining discussion, the latter two items we can walk through in relatively short order. So if you look on page 7, infrastructure now, there are existing investments within infrastructure. Per the new policy, there's a 4% target allocation to infrastructure. So I did, before talking about how to think about moving forward, I did want to provide information on the current exposures, and you see them in the sub-bullet points behind the first main bullet point. So right now, there's about a 0.6 percentage point allocation to iCapital Pantheon Private Infrastructure Fund 3. That is one of those closed-end funds, a legacy investment. That is a closed-end fund, and again, that is owning and operating infrastructure assets. That is complemented by a 3.5% allocation to Cohen Steers Global Listed Infrastructure. So again, a mutual fund where Cohen Steers is buying and selling the stocks of companies that own and operate infrastructure assets. So that's where things stand now. If you recall, during many of our meetings and discussions last year when we talked about asset class education, the roles in the portfolio, sort of our optimal or highest conviction way to implement an infrastructure allocation, we talked a lot about private open-ended infrastructure. So I'll walk through this more detailed here shortly, but just as a quick reminder, private open-ended is not daily valued, they're not publicly traded securities, but it's a fund that would operate in perpetuity. So your money is not locked up, right? You can contribute it and then ask for it back, usually on a quarterly basis. You're not waiting 10, 12, or even years or even longer to get it back. Now, why would you do that? Instead of just going the listed route, number one, the fees are generally comparable. Number two, obviously, the underlying assets are pretty much the same, right? We're just talking about infrastructure assets. But one of the primary benefits is because it's private, it's not valued on a daily basis. So the stock market, which, as we've seen, is quite volatile, and the equities are very, very volatile. If you use a listed approach, then the fund has to tolerate that volatility. Now, on the private side of things, and we'll talk about a couple of the managers, one of them values it on a monthly basis, another one does on a quarterly basis. And I'll admit that the smoothing effect that happens, if you value something less frequently, it's going to, just by definition, have lower volatility. But that smoothing effect is how these things work, and it's actually helpful for the fund. So it would be, if we used a whole listed manager for this allocation, you'd have the equity market volatility. This private approach would be a smoother ride within the asset class, probably comparable returns, but the smoother ride, and then a smoother ride for the assets for the overall fund, which then hopefully lower volatility of funded ratios, more budgetary certainty. So it's a domino effect. Essentially, if we're thinking about this more private, open-ended approach than just using essentially a listed equity manager or a mutual fund to get the exposure. And more to that point, I looked up some numbers in Q1 of 2020 when the global equity markets were down from peak to trough around 30 35% or so. Well, the managers I'll show you here, one was down just 4%, the other one was actually slightly positive. And then in January, the preceding month, where global equities were down 6%, one reports on a quarterly basis, so we don't know yet, but the other one was essentially flat. So you get less downside, you're gonna get less upside as well if the markets rebound rather forcefully. You're not gonna see the same level of upside. So the pattern of returns is much smoother over time. It'll get you to sort of the same place as a regular equity investment, but again, the positive benefits of having that smoother ride, you'll see more from the actuarial side of things. Questions or comments around that before we dive in? Yes, sir.
You had mentioned that on an open-ended fund, our money's not locked up, we can get it back.
Yes, sir.
Did I hear you say that might be on a monthly or a quarterly basis?
So the two managers that we'll talk about value, one values or essentially puts out statements on a monthly basis. The other one does it on a quarterly basis. As far as the liquidity, and I have a slide on this, one of them has a quarterly redemption option and the other one is actually semi-annual.
Okay, so bringing me to the second part of that then, is there a cap on the amount of the redemption?
Not for the manager that has it on a quarterly basis. For one of the managers, they do have what's called a soft lockup. And I have more information around that, but just to give you an overview, within the first 4 years of your initial commitment, if you ask for your money back, and again, this is just one of the managers, you take a haircut of about 96 cents on the dollar. And the reason they do that is because they want long-term investors, right? Because if an investor wants to make a redemption, there's a cost to that everyone bears, right? All shareholders. So in order to really concentrate that on whomever is pulling the money, that's why you take the discount. So it's a disincentive for more short-term investors to say, hey, we like the asset class, let's commit money, and then a year later say, just kidding, we'll pull it back. But with one of the managers, then you're going to take the haircut because they don't want the other shareholders to bear that cost.
Okay.
Okay. So on page 8, the next couple of pages, just want to give you a high-level overview of some of the managers under consideration. Then we'll dig into the exposures, the returns, the terms and fees, which we've discussed, and some of the pros and cons as we look to round out the discussion. But you can see here on page 8, there's two managers we would like the board to consider, the first being JP Morgan, obviously a household name. You can see in the first sentence there, again, it is an open-ended fund, so operates in perpetuity, not like a closed-end fund, which winds down after 10 or 12 years or so. Really, in that second sentence, you can see in the second line, a majority of their assets are really in utilities and renewable power. In other words, more contracted assets, distributions, regulated assets. And I mention that because, as you'll see shortly, they're generally more diversified, and these areas of the infrastructure market are generally a little bit more conservative. In other words, they don't really, or they aren't nearly as sensitive to what's going on in the overall economy, as opposed to more assets like toll roads or airports or seaports and things of that nature. And then finally, in the third sentence there in the middle of the second line, and then really towards the end of the sentence and the beginning of the third line, you can see that their assets are invested across developed market economies, mostly the US, UK, and continental Europe. The second manager, one of the really interesting dynamics here, Industry Funds Management, or IFM for short, and you see in the first line there, actually owned by 29 Australian pension funds. So that's a pretty big differentiator, and think about that as an alignment of interest. In other words, the investors are also the owners. So there's a lot of skin in the game, and what that has resulted in over time is that the investors have driven the fees down to very, very low levels, at least on a relative basis, as the fund has grown and grown. Another thing, again, this is an open-ended fund. One key difference in the third line there you'll see is it's primarily developed market infrastructure, but as I'll show here shortly, they do have one asset in an emerging market economy, namely a toll road in Mexico. And as you'll see, they predominantly have more investments in more GDP-sensitive areas, again, the toll roads, airports, seaports, things of those nature, and it'll be evident in their return profile because they've taken a little bit more risk, they've been compensated with a higher return, but the path along the way has been a little bit more variable than JP Morgan. So with that said, on page 9, before we get into some of the exposures, I just wanted to highlight a couple of quick things here. In the top table, in the second column there, you can see firm assets. Obviously, JP Morgan, quite large, about 2.6 trillion. You can see the next line, that's the strategy asset value, GAV meaning gross asset value, NAV meaning net asset value. So the former incorporates leverage that these managers use, which I'll provide more color on here shortly. So you see the 38 billion, obviously a sizable strategy, but somewhat of a drop in the bucket for JP Morgan. Whereas IFM, they have about $130 billion under assets under management, but the fund itself under consideration in that third row is almost half of that. So this is more of their flagship strategy, their core competency for the firm itself. The other thing I wanted to mention, obviously we're bringing two ideas to the board, but with the firm itself, we have 70 clients invested in the JP Morgan fund with around $800 million combined. IFM, it's a little less from a quantity perspective, but assets are more than 1.2 billion. So like we talked about with the asset allocation and the asset class education, we are big believers in this space, and these are essentially our two highest conviction ideas within the asset class. The other thing I wanted to point out on the bottom table is there's not much differentiation, but just to confirm with the board, all the way to the right, the fund inception date, you can see JP Morgan's been around for about 14 and a half years, IFM for a little bit more than 13 years. So it would be in compliance with the new IPS of managers having a 7-year track record. If you look on page 10, we'll get into some of the exposures. What you'll notice, as I mentioned, JP Morgan's here in blue, the first 5 columns, if you will, developed market economies, right? So US, Canada, UK, continental Europe, Australia, New Zealand, all their assets are predominantly concentrated there. Where IFM in orange, it's a similar, except when you get to continental Europe, they have much less allocated to the continent than JP Morgan, with a lot of that respective or relative underweight to JP Morgan flowing through to Mexico that you can see to the right there. So they have a sizable allocation again within an emerging market economy. Again, it's a Mexico or a toll road within Mexico. So if we think about a regional allocation perspective, IFM a little bit more aggressive, not just invested in developed market economies, but does have a material allocation, again, to a toll road within Mexico.
But IFM, which is from Australia, doesn't invest in Australia.
That's I can't comment on that, but that's a very astute observation,
Okay.
to say the least. So from a regional perspective, again, a little bit more aggressive IFM than JP Morgan. And if you would all please flip the page to page 11 here. You looked at the sector allocations, and if you look at the table up top, again, these are the various sort of subsectors across the infrastructure universe, broken down by their sectors, sort of in between the lines at the bottom. But what you'll notice on the chart, more blue than orange. So what does that essentially mean? Again, sort of JP Morgan's a little bit more diversified than IFM, right, within the utilities and energy space, those first 2 columns. Not as much in transports because that's the GDP sensitive area, but then in renewables as well. And then in orange and IFM, you can see a lot of concentration in that transport area. So about, the second third of that chart, decent allocation to airports, to toll roads, to seaports. And then their other largest allocation is really within energy, further to the left, midstream services. So what that is essentially, for those who don't know, essentially is upstream, midstream, and downstream. So upstream is really production of energy. Midstream would be processing, storing, transporting that energy. And then finally, downstream would be the last part of the piece where they're refining the energy into jet fuel, diesel, or refined gasoline, but so more in the midstream services in the energy component. So again, from a regional perspective, sector perspective, IFM a little bit more aggressive, and that's also evident in page 12, which I think is really interesting, just breaking down the portfolio diversification revenue. In other words, when you look at the 3 buckets, where are the cash flows coming from? So JP Morgan, they're pretty even distribution across the 3, and actually the largest bucket in that distribution regulated bucket. So think again, electricity grids, water utilities, things of that nature, compared to, again, IFM that has more allocated to those GDP-sensitive areas, again, the airports, the toll roads, the seaports, things of that nature. So when you think about sectors, revenue, again, IFM a little bit more aggressive than JP Morgan. And before we get to the returns, just on page 13, a quick illustration of the historical leverage profile for these funds. So much like, a lot of private open-end and closed-end vehicles, they do use leverage. Essentially, they'll borrow money to invest alongside investor capital. But interestingly here, now the story or the script has flipped, whereas you can see JP Morgan historically has run a much higher leverage profile than IFM has. So even though they're a little bit more aggressive from a sector and regional perspective, how they invest investor capital and use leverage to invest alongside of it is much more conservative than JP Morgan. So key really distinctions about how they're not just diversified from a sector and regional perspective, but also sort of risk controls of how they're investing their investor capital, alongside the borrowing as well. So with that, let me pause quickly before any questions here, and we'll run through the returns here in just a second. Okay. So on page 14, you can see the historical returns for the two managers in blue and orange respectively, and the top chart is showing the same thing as the bottom chart. So if I can draw your attention to the bottom chart there. JP Morgan's the first line there, and as you work your way from left to right, and I should mention these returns are net of fees, pretty consistent, right? 1 year, 3 year, 5, 7, 10, right around that 7% mark. So again, strong long-term returns, not quite an equity return, not quite a fixed income return, somewhere in the middle, but very consistent given their more diversified approach, whereas IFM, just below them, you can see the returns have been much stronger over time. So again, they incepted, if you recall, as I showed earlier, at the beginning of 2009. So when was that? Right at the end of the financial crisis, after the longest economic recovery in history. So having a little bit, or being a little bit more aggressive, has certainly helped them generate those strong long-term returns, and on a 10-year basis, really a 3.5 percentage point premium to JP Morgan, which again, might not sound like a lot, but compounded over 10 years is a much higher return. Now on page 15, again, I just, those are the returns, but I want to illustrate some of the variabilities. So again, if you look at the bottom table here, I think this will be pretty evident. And again, top two rows, JP Morgan, IFM. So skip year to date there for a second. I think 2020 is quite instructive, and then 2019 will show you the other side of the story. So in 2020, again, amid the pandemic and the stay-at-home orders, lockdown, the economic impact, JP Morgan posted a pretty respectable return of about 5.3%. IFM was about half that level because they saw a negative return in Q1 of 2020 of down 4%, and then had to dig their way out of that hole. So in a poor economic environment, they are going to underperform JP Morgan, but over the long term, they've generally been compensated for the risks that they're taking. And I think that what's evident of that really just 2019, so the column to the right there, pre-pandemic when the economy was doing very well. Again, JP Morgan rather consistent, kind of in that 7-8% range, but IFM up 15%. So when the economy's firing on all cylinders, they should be doing better than JP Morgan, and certainly vice versa. Now, to spend a couple of minutes, starting on page 16, just to give color to some of the questions earlier around the fund terms. So for JP Morgan, there's a minimum account size of $2.5 million. As I talked about earlier, their redemptions are semi-annual, and then their subscriptions are monthly. So in essence, if you wanted to move forward with JP Morgan, they accept investors on a monthly basis, and then they'll call the money or ask for it when they're ready to invest all of it. If you look all the way to the right, that's the restriction that I talked about earlier, the 4% redemption holdback. Again, that's just within the first 4 years. Now, if we contrast that with IFM, you can see $10 million down. There's an asterisk around the minimum. That's not $10 million. They waived that below to essentially $5 million for this opportunity. It's something that is consistent with that 4% target. So if the fund's 130 million, 4% of that would be a little bit more than $5 million. So that's why we brought it to your consideration, because you can meet the minimum. And then you can see the liquidity there is a little bit better in the terms of redemptions on a quarterly basis, and there are no restrictions, so no lockup. So to your question earlier, Mr. Walters, if you add the money, did they ask for the money on day one, and for whatever reason, the board would like it back, then you can ask for it back, and you don't take any haircut for that redemption. So with that said, we'll wrap up here on the fees on 17, and then we'll do the pros and cons on the next page. But so as far as the fees are concerned, as you work your way from left to right here, you see the fee schedule. That's essentially the management fee. So JP Morgan's at 90 basis points, or 0.9%, whereas below that, you can see IFM is decently lower, about, call it 15% lower at 77 basis points. Now, much like the closed-end funds, these managers charge a management fee and what's called an incentive fee, here denoted as a performance fee. So what that means is, when they're doing really well, there comes a time when investors split the profits with the managers. So I want to walk through a quick example of that here. So if we simply assume that we have a 10% gross return, we'll start with JP Morgan. Their fee schedule, or their management fee, is 0.9%. So the net return is 9.1. Now, it's doing things arithmetically. If we do it geometrically, it'll be a little bit different, but I won't get into that. So it's 9.1. So since that 9.1 is above that hurdle rate that you see of 7%, then the performance fee kicks in. But it's only on the incremental return, right? So the 2.1 percentage points that you're above the 7. So of that 2.1 percentage points, then the investors keep 85%, and 15% goes to JP Morgan. So taking into account management fee and performance fee, a 10% gross return turns into an 8.8% net return for the investor. Now for IFM, as I mentioned, the management fee is lower. So again, if we do 10%, the net return before the performance fee would be 9.23%. But notice their hurdle rate is higher. In other words, they have to post a better return than JP Morgan before the profits would be split, and also their performance fee is lower. So if you have that net return of 9.23%, it's only about 1.23% above that hurdle. And then you keep 90, they keep 10. So the long and short of it is, in this exercise where we're assuming a 10% gross return for each manager, JP Morgan, you'd end up around 8.8. IFM, you'd end up around 9.1. So the fees for IFM are a little bit more investor-friendly, certainly not just from the management fee, but also from that performance fee perspective. So to wrap up the discussion here, and then happy to take any questions or comments on page 18, the pros and cons, and hopefully we've been able to illustrate these well. When you think about IFM, very strong long-term returns, more liquidity, lower fees, as I've outlined on the last 2 pages. But they are less diversified, provide less downside protection given the GDP-sensitive assets, as we talked about in the earlier pages. JP Morgan still delivered reasonably strong long-term returns, more diversified, more consistent returns over time given that diversification, but higher fees, less liquidity. So again, we have high conviction in both of these managers, and they obviously operate in the same space. But there are pros and cons with each, as opposed to, from a risk perspective, but also from a fee perspective and a liquidity perspective. And the latter is obviously a key component of risk as well. So with that, let me pause here for a second to answer any questions or comments before we proceed with this discussion.
One question, maybe.
Yes, sir.
So with respect to the waiver of the 10 million
Yes, sir.
for IFM for Marquette clients, does Marquette financially benefit from any of that? Just
No,
for the
sir.
record?
No, sir. So what we do is we try to, for lack of a better phrase, drop the metaphorical hammer on these investment managers, and we're only paid by our clients, nobody else. So the reason behind that, to drive lower fees, is, again, be more dollars that stay in the fund, lower fees. Hopefully, over time, we do a good job and essentially continue a relationship. So we don't, if the board wants to choose either of these managers, neither of these managers, our compensation doesn't change whatsoever. It's more from, we're bringing this to the table because we think it's a good idea from a fiduciary perspective.
So none of this is sticky money as we have experienced in the past?
As far as the closed-end funds? No, it is not locked up. The only stickiness, if you will, is obviously it's less liquid than the public stuff. And if you decided to go with JP Morgan, you can still get the money back, but you take that haircut within the first 4 years. But it operates in perpetuity, not like those closed-end funds, and you control the cash flows.
Do you have any thoughts on page 11, why there are so many interesting categories that neither one of them are in?
Under communications?
Well, under, like almost any of those. I'm on page 11.
That-
Utilities, non-diversified energy, 2 categories they don't do. Commo, they don't touch at all.
Yeah, I think it's the nature of, these guys are going to be, number one, thoughtful about how they implement. Obviously, they take into account their long-term economic outlook, which would include these various aspects. But if something is expensive, they're not going to overpay for it. And certainly related to some of those other industries, if you just look within energy, natural gas pipelines, petrol pipelines, they have some exposure in there, but they think the more thoughtful way to do it is the storage, right? Just the transportation, the storing, the processing of it, as opposed to own the actual pipelines themselves, which are a nichier area of that energy market and probably carry a little bit more risk. And then as far as communications, those are certainly considered infrastructure assets. The fact that they don't have any isn't terribly surprising. We actually find more real estate managers dabbling in that space these days. Although they are certainly considered infrastructure assets, we find, again, real estate managers are making more of those investments where these guys are sort of sticking to the more traditional type of assets, whether they be, or from an infrastructure perspective, again, whether they be utilities, electricity grids, toll roads, renewables, so on and so forth.
But this chart is a snapshot in time. They're not
Yes.
precluded.
No, not at all. Not at all. No, I apologize. Yes, these data are as of 9/30, and we essentially asked them to fill this data out to present it to clients. So this is how they filled it out, and if they think any of these areas where they don't have the exposure, or if they think they're attractive moving forward, then they are not precluded from investing in those areas.
So if I'm to think about these two options, if we had to pick, there's really 3 things that we have to consider, if I'm hearing you right. And that is, are we willing to pay increased fees, or what's the premium we're willing to pay relative to each other for consistency on returns, right? And then how big of a risk can we tolerate, considering IFM does more work in developing countries and more at-risk GDP areas versus JP Morgan, which is a little bit opposite. And then how important is liquidity to the board? Versus, obviously, IFM, you say, is monthly or quarterly, and JP Morgan semi-annual. So,
And then JP Morgan has that additional soft lockup, if you will, where
Right.
you can get it back, but you take a haircut. So you're spot on, Lieutenant. I think those are the 3 main considerations. When you think about the asset class within the construct of the fund itself, as I showed earlier, with the fund itself, the cash flows are still very much positive. So I'd certainly argue, especially in light of the allocation targets that were reduced to many of those other more liquid asset classes with the new IPS, that the fund, again, since the cash flows are positive, can tolerate, the illiquidity of this investment, and can admittedly probably tolerate, a more aggressive manager within the 2. So I wouldn't have you guys shy away from that. But it is a key component of the discussion. But again, since we're having positive cash flows here, if we continue to do so, we're not going to have to sell something at the wrong time to meet cash needs. So the ability to take risk, I think, is a little bit higher than many other plans out there that have the negative cash flows and have to take that into consideration.
So when I look at page 14 that shows their returns, shows the returns of, over the 10 years, I guess I think back to what I know in this field, and that is, one, the S&P historically returns, 10, 11% over time?
10-ish is
10-ish?
fair.
Okay. And 85, is it 85% of the actively managed funds don't meet that? Isn't it a huge percentage?
Over the past decade, that's
Okay.
fair. Just like anything
Okay.
that's cyclical
Right.
over time.
Right. And I don't think I'm smarter than 85, so I guess what I look at is, from my personal, I'm happy with 10% growth, right? I know that we say our target is less than 10%, isn't it? Or isn't our target like 6 or 7?
7.25.
7.25, right? So if you were to look at page 14 and look at these, but then just throw up a simple Vanguard S&P 500 index, where would it fall with its low fees for the 10-year?
Over the 10 years,
Sure.
I have to go back to my earlier book here, and I can give you
Oh, sure.
an exact answer.
That's perfect.
But before, and as I work through this, remember that obviously the fund has a lot of equity exposure and has a lot of passive exposure when we think about these asset classes. And
Well, you're diversifying, right? Is
you're
that one-
diversifying,
right.
and we'd argue you're getting inflation protection.
Right.
Because again, a lot of these assets are either land or the cash flows they throw
Right.
off are tied to inflation and things of that nature. So it plays a distinct role
Right.
in the portfolio. But the last 10 years, 16.6 for the S&P,
Right.
which is quite the anomaly, we'd
Okay.
argue. And just like anything,
Okay.
those markets are cyclical too.
Sure, sure.
I'd be willing to say that as if we're sitting here in the next 10 years, we're not going to be anywhere near that number for the S&P.
Right.
Pat,
Go ahead.
I'm sorry, excuse me.
Yes.
What asset class would this be?
It would be, from an investment policy perspective, it
Yeah,
would
so
fall
where
under
would it
real,
fit?
the real assets.
Would be real, right, which is a
Okay.
total of 10, and we can
Yeah.
do 4, 4, and
Two.
2, and this would be one of the 4, right?
Yes, sir,
Think,
spine.
Right.
Okay.
I just,
So still on 14, is the CPI the headline or the core?
The headline. And those, excuse me, those benchmarks are really for reference. Some, it all depends on how clients source the money or how the role in the portfolio. So some have used it as a fixed income substitute, rightly or wrongly. As far as the fund is concerned, this would be more of an inflation protector. So the CPI would be more of the bogey that we're looking to meet, or sort of the role, the inflation protection itself. But it really depends on the individual client, how they bucket the asset class, and what's the point of actually investing in the asset class like this.
and I know, we just approved, didn't we, like not an index, well, sort of an index fund in real estate, didn't we? What was that one we looked at that was,
Earlier last year, that was a mutual fund.
right?
Right, because a lot of the legacy private open-end funds, we were trying to move out of from a fee perspective. And
How does that
liquidity.
compare to this? Is it apples and oranges, or is it, I guess it was real estate, but it wasn't into all the energy and stuff like that, right?
Right. So the real estate would be more commercial real estate, your
right.
offices, your apartments, your industrial, your retail. So when we get to next steps, actually, we'll be talking about the next steps to look at the real estate allocation as well.
And for what you're presenting with these two options, are there any sort of mutual funds that fall into this category, or this is just so different or beyond?
So there are mutual funds like Cohen and Steers, which the fund has.
Right.
But it's a mutual fund. Which is a totally different animal than
Right.
this sort of private, open-ended approach. So there would no mutual fund would fall under this bucket.
I gotcha. And when we talk about diversifying, We are, what, approximately 140 million, give or take?
Probably closer to 130.
100, okay.
As we
Right,
sit here.
Right, right, okay. 130, and you're talking about 4% would be about 5 million, or?
So 4% of that 130 is 5.2. Right now, we have 0.6
Right.
in the closed-end fund, which will wind down. Would like to keep a slight allocation to the mutual fund manager just for liquidity and rebalancing purposes. So this would essentially be the bulk
Right.
of the 4%.
And so it's not investing too much into this. It
No, it would be,
fits our.
it would be in line with the policy target, yes, sir.
Gotcha. Okay. So you're looking at us for a motion? What is the next step in this?
Get the money.
I'm sorry, I didn't hear you.
Where does the money come from?
Well, the money would come from, so again, if the board decides to move forward, these managers will ask for it when they're ready to invest it, and I would expect that to be towards the end of the year or even early next year. So it would come from mostly the listed manager that's already at 3.5%, or hopefully we start getting money back from the closed-end manager that's at 0.6%.
So we're back into needing to warehouse cash,
No, we can
call for this?
No, because when the call does come, we can liquidate most of that mutual fund, and the cash is ready the next day to then use for the investment.
And then you would take some of the cash from some of the private things when we finally get them to put them back in the mutual fund. Is that what you were?
Hopefully, but as you know, we don't control.
Right, right.
Or we have no control over when those funds come back in, and that's why we update the reports and then those rebalance sheets to give you the
Right.
most up-to-date sense of where those things stand.
So what I'm hearing is this investment is still being assembled. It's not actually in play because you're not asking for money.
No, so what I think, if I'm understanding you correctly, Mr. Walters, to circle back to Mr. Weisskopf's question, for today, if the board was prepared, we'd be looking for a motion to select one of the two managers and approve a $5 million commitment. Then from that point, we go to the managers, need to get the documentation, work with the county attorneys to make sure that everything, they're okay with the documentation. We get it filled out and executed, and once it's executed, then it might be a quarter or two or three before they ask for the money. And at that point, we come back and we say, they've asked for the money, we get a more up-to-date value of where things stand. So does it come from all Cohen and Steers? Have equities rebounded and rallied up? Does it give us a chance to rebalance and things of that nature? So that part of the decision can wait until whenever the managers actually ask for the money, which again, could be later this year or perhaps even a year from now.
So, but obviously, we don't start earning any returns or anything like that until they've got our money in hand.
Right, but it's
Right.
already invested. It's not sitting in cash
Right.
for 9, 10, 11 months.
Right, right. I'm with you.
Well, looking at page 14, the thing that catches my eye, it looks like JP Morgan is running at or below the CPI plus 5%.
They have, and a lot of that's due to what's happened over the past year. So even though this is sort of a real asset or inflation protection, these cash flows don't change in a month or a given quarter. They increase over time based upon the economic environment. But to your point, Mr. Walters, over that 1 year with CPI being up, again, the state is as of 9/30 up 5.6%. is influencing a lot of that 3-year and 5-year results where they've been a little bit behind of that bogey.
What I like looking at, I like IFM for two reasons, right? One, the lower fees. I just hate to give my money to somebody else. But two, historically, it's done better. But what you're telling me is that they are more risk adverse to fluctuating markets, which, the stock market, which it seems like that's where we're kind of going, right?
We think that the entirety of an investment like this is more immune to those things.
Okay.
So either option would provide that sort of benefit, if you will. So I wouldn't look at it compared to what's going on in equity markets, since we have a dedicated target to the asset class and the role we want it to play. It's really the relative merits between the two for a couple
Right.
of reasons you just
Right.
spoke to.
But part of this immunity comes from not having daily pricing
Right.
Most of the
Right,
immunity.
right.
smoothed out.
Yeah, and like I mentioned earlier, I'd be the first one to admit that, but at the same time, that's the nature of how it works, and
Well,
there is,
yeah, and I'm
and there,
okay with that.
yeah,
Right.
and there is a benefit to the fund, to the smoothing,
sure.
right?
I like IFM. I don't know.
I mean, if we look at the 10-year return on page 14, JP Morgan was 7.5% to 7% over that span of time. IFM was 18% to 10%. So an 8% swing for them.
As far as the range,
Yeah.
yeah. So they have,
Consistency wise, JP Morgan is far more consistent.
Right, right.
We're going to pay for it.
But they're-
and we're
they're
going to
like-
still be ahead of CPI.
But they're like the little engine that could, right?
But they have also,
They're just chugging along at your 5 to 7% versus chugging along at 10 to 18%.
but from a
With lower
macroeconomic
fees.
view, you know, if we want to go with the sure thing, rather than risk an 8% swing in the next 10 years as they start to call for money and
well, the
thinking about it wrong,
no, I'd just say, Lieutenant, the 18% was obviously the 1 year. So from year to year, yeah, you're spot on. There's a wider range of dispersion in any given calendar year. But that said, you know, if you look 3, 5, 7, 10, we're kind of in that 10 to 13-ish% range. So the range is a little bit wider.
Right.
But
their bottom-
the low end of the range is obviously higher than.
Right.
than
Their
G-
bottom was 5%, 5.2, whereas JP's was 1.8, and JP charges more money in fees. But,
I don't think we need to rely, or we shouldn't rely on the 1 year.
oh, no.
I mean, that's an anomaly.
Okay.
I'm looking out there at the 10-year mark, and JP Morgan, return of 10, no, I'm sorry, 7 even. And CPI plus 5 is 6.8. If we were just keeping up with inflation, we're not doing very well.
Right.
So we put the extra 5% on there if you're up in there, and they're barely ahead of that.
Right. Right. No, I mean, if we're going with JP Morgan, I'd rather just put it in an S&P 500 index fund.
correct.
Yeah, I would,
That's, so what are your thoughts?
well, if we're going to do this type of thing, I'm leaning to IFM.
Jeanette?
JP Morgan.
I'm IFM.
Having to pick IFM for me, but, I'm sorry, JP Morgan for me, but at the end of the day, a mutual fund, that's where I am, and not trying to get sucked into this microeconomic view of all the geopolitical events and the volatility that's happening now, or, you know, but there's some economic uncertainty coming. and
Exactly.
I'd like to hedge against it, which is why I'm with JP Morgan and these two.
More diversified, more consistency.
I'd rather
I'm not
take it.
happy about the high fees, but I appreciate those two items.
I'd almost prefer to do nothing than to give the plan more exposure to risk.
Right.
And maybe that's too short-sighted, admittedly so.
So if we think about, right, the asset class itself and the current implementation, what we have is mostly listed equity, right? And again, there's so many different ways to measure risk. If we think about volatility, this approach is better than a listed equity approach. We're thinking about illiquidity. Obviously, there's you know, drawback to this approach than that approach. But, you know, when we think about, you know, the comments around, you know, just putting it into equities and things of that nature, you know, we already have a ton of that, right? So this is more of getting us in line with the new IPS and having protection against inflation, because if it is more persistent and higher, given equities, even though they're down 15, 16%, are still, we'd argue, somewhat overvalued. And you think back to the 70s, which is really the only historical analog we have for that sort of environment. We ended the sort of mid 60s, late 60s period pretty overvalued, and then when inflation started to rear its ugly head, what really hurt the market was the beginning of that period we were overvalued, and then inflation was high and persistent, and then at the end, when we entered the 80s and the early 80s, markets became unbelievably cheap. And the economic environment, largely inflation, was a key driver around that.
Right.
So again, it's more of a, we'd argue sort of the role in the portfolio that we're trying to have protection against, right? When economic recession, deflation comes, that's when we want fixed income, high quality bonds as that insurance. When we have inflation rears its ugly head, then we have real estate, infrastructure, treasury, inflation protected securities, which we won't need to meet benefit payments, but could give us the opportunity, like we talked about today, to rebalance back into that growth engine, those equity markets after they've already declined.
Well, if we don't think there's going to be a quick spring back, and I'm kind of leaning in that direction, but why don't we look for an infrastructure-centric ETF or mutual fund, as opposed to just looking at these two? This is A or B, it's just, what do they call
Right.
it?
So maybe give us a C?
Well, we have one,
We,
right?
yes, so we have one
Right.
in
The Cohen and
Cohen and
Right.
Steers, but so when we put together the policy, again, it was based on the discussions and the education, all that, it was under the assumption that an investment like this would play that role. Essentially, the benchmark for that allocation is CPI plus a premium. So if we keep it with an equity bucket, there's going to be a pretty big mismatch between how we've implemented this and how we're measuring success.
Right. But Mr. Walters' point to me is the most important one, that JP Morgan's not matching your CPI, right?
Plus 5%.
Plus 5, right. And if you're not doing that, then, right. So I'm with you.
I know this is kind of a niche, you've used that expression before, but this is fundamentally a different way of looking at an equity bucket, is it not?
Sure, I think that's fair. Again, when you think about, this is equity ownership, right, of the underlying assets. So with that in mind, absolutely. Now, the underlying assets themselves, compared to broader equities, we would think do better in an inflationary environment, just given the nature of the way they generate their cash flows compared to broad equity, which is, a hodgepodge of different sectors. But to your point, it's equity ownership of the underlying assets themselves.
Well, I guess my current position is I wouldn't make a move on either of these two today. I'd do a little more snooping around to see what our other alternatives are.
I agree.
Well, it sounds like a vote would be a tie anyway, so.
So my question, Pat, is you're fiduciary of
Yes, sir.
this trust. What are you, we have an A and a B, and they're vastly different. So we're debating the merits of which one's better, or, what would you do?
So from an asset allocation perspective, obviously I've already conveyed those thoughts with the new IPS. With these managers, again, what I bring it back to is what's the funds, and it's very different than the board's willingness to take risk, but what's the fund's ability to take risk, right? And then in order to measure that, I'd argue one of the key metrics is cash flow. Again, to reduce or completely mitigate the risk of having to sell something at the wrong time to meet benefit payments, right? So as far as the A and the B concern, to your question, Lieutenant, I have clients that invest in both of these funds. The ones that have that are large enough to meet that $5 million minimum, usually use IFM at our recommendation. But again, boards are different as around their willingness or not.
But it's your opinion, if I'm hearing you right, that our plan, based on your experience, that it can tolerate the risk of IFM?
Based on the cash flows, yes, I'd agree. And again, using this approach on the private approach, we'd argue would mitigate the risk as compared to using a listed equity approach because of the volatility inherent in the latter.
Maybe we could table it
Yeah, revisit
and then
next month.
ask Pat to, come back next time and see if there's something else. And
Okay.
if the recommendation remains the same, maybe we take action then. Just not today.
I agree.
Yep,
So just to set expectations, within this asset class, there's really nothing else unless you wanted to stick with the listed equity approach, but then I'd argue we need to amend that IPS because there's going to be a huge mismatch with how we implement something versus how we're measuring it or, what the purpose of it is.
well, I think we just have this same presentation next time when there's 5 of us. Honestly, right?
Right.
Yeah, if we're gonna have to take the action to
Right.
stay in line with the IPS.
Or change the IPS.
Right.
Right. Right.
That IPS was also created when things were a little bit more stable and not looking to the current situation that we're in.
Sure what's happening is going at this point.
Okay.
So have you moved to table?
Sure. I moved the table of this conversation until the next meeting.
I'll
Second.
Got a first and a second, all in favor?
Aye.
Aye, ayes have it, motion
Sorry,
carries.
No, not at all. I mean, I'm happy
All
to,
right, Pat, you got 12 more minutes.
I only need 11. No, I'm just. So under, just quickly, if in the next exhibit, custody RFP update, as most of you know, we had presentations earlier from the 2 remaining bidders. Those have been scored by the evaluation committee, and Brandon from procurement has that. He'll be working on the tabulations. Ms. Pratson and I have talked to 3 or 4, maybe 5, I lost track, of the references so far. We have most of them on the docket for tomorrow and early next week. So we're moving along. That's long and short of it. And then once the presentations have been scored, the references have been scored, the cost proposal will be last part of the equation. So I'm hopeful, I don't know if it'll be by the next meeting, but at least by April, we should know who that award is going to, I think is a reasonable expectation, but that keeps moving along. And then the last tab is next steps, and you've seen that list before. So when we come back in March, just to reiterate with the board, we'll have the recommendations as we always walk through, and then we'll revisit this discussion as well. And then I think those will be the, and we'll have the custody RFP update. So those will be the 3 agenda items, if that's amenable to the board.
Sure.
That works.
So this is not a case of you're not going to do business with us if we keep asking questions.
No, I love questions. I love questions. I've been in a lot of meetings where there aren't many questions, and
I'm referencing Catbert.
yeah, that's right. Question just means that everybody is fulfilling their fiduciary responsibilities, so that's the most important thing at the end of the day, certainly. So with that wraps up everything for me today.
Thank you, Mr. Wing. Next is the administrator's report.
We don't have any expenses today.
Okay, do I need a motion on that?
I don't, normally we would.
No, I'm teasing. I don't think we do. For public comments, that's me. I do have one thing. It was brought to my attention that we have another certificate of appreciation this week. It goes to John A. Walters for your service on this board. So thank you very much.
It's county government, Joe.
Easy, easy.
Yeah, but the last one you gave me was my first meeting, and
I know.
that's the shortest tenure of any board.
Right. Well, maybe when you come back next time, there'll be someone else sitting there. We'll see. But,
May I add one item
Yes.
also? Just to let the board know that we've received a disability application, so that will be presented as I work through that process. And you may recall that that would be a closed session item.
This is a new disability application?
Yes.
from-
Yes,
Okay.
yep. Yep.
Brand new, not the one we were sort of talking about before.
Different individual. Yep.
and what happens is you look at it, you bring it to the board, and you make a recommendation, and there's basically three options, right? If I recall correctly?
So there's three different types of
Right.
disability, but the other option is that it doesn't qualify.
Oh, right. There's always the denial, I guess.
Right.
But, so there's four options, right.
And then they, just as a reminder, so one is an ordinary disability, that is a disability that was not suffered in the line of duty. One is a line of duty disability, and then one is a catastrophic disability.
Right. And the catastrophic one basically comes from Social Security, or somebody else has to make that or workers' comp?
The catastrophic would require that you're filing for Social Security disability also,
right.
and you cannot do any job.
Right.
The-
You're 100% disabled, I guess, is the...
Right. The line of duty requires that there's a workers' compensation determination that it is line of duty. And then the ordinary is, those requirements don't exist.
Gotcha.
That is, you can't do your current job.
Right.
So,
Okay, well, if there's nothing else, I will entertain a final motion to adjourn.
Motion to adjourn?
Second.
I have a first and a second. All in favor, vote aye.
Aye.
Aye. Ayes have it. Meeting adjourned.